My name is Femi Oladehin. I'm a chartered accountant and investment banker. I will be taking the class on finance for small businesses. This is Dang Masterclass. A lot of businesses that die usually die because the entrepreneur sees himself as the business. The business is not you, and you are not the business. The only thing you are is you are the face of the business. You know, I know that the corporate laws in Nigeria are changing soon. I think there's a new KAMA that's coming out in a few, which now means that you can own a business 100%. As an individual. In the past, you needed at least 2 shareholders or 2 directors. I think the new laws that are coming out means that you can own it on your own. However, there's a danger with you mixing the business's finances with yours. If you do not have the discipline to separate both of them and pay yourself from the cash flows that the business is generating, the tendency is that when you have emergencies, you will always go back to the business to fund those emergencies. And one day you're going to run out of cash. It's very simple. An entrepreneur must have the discipline of paying themselves from the profits of the business and not from the sales of the business. The problem with commingling the costs, commingling your cash, is that you will not know when you're paying yourself from your capital. One day you're going to wake up and realize that oops, there's no capital left in the business because you've basically used the capital to run your own life. However, if you have the discipline of ensuring that your business has its own bank account, you have your own bank account. If you need to move monies around between those bank accounts, you might as well do that. But always make sure that you have records and you understand that every cash that you take out of that business is a depletion of capital. Because from an accounting point of view, capital is defined as the owner's capital as well as retained profits. So it's either you're depleting your retained profits or you're depleting your capital. You have to be careful because if you go back to where we started from, you will run out of blood. And when you run out of blood, you will die. There's no right or wrong time for you to start paying yourself. As long as your business starts to generate positive cash flows, and as long as you do not require reinvestment within a period of time. And so let's go back to when we talked about the budget. If you have a budget, you will know that in the next month, I require to restock, for example, and you will know not to start paying yourself monies that you would have ordinarily used to restock. So if you start to that discipline of saying, I have my budget, there is cash that is required for the next 6 months. Do I ensure that I have cash to run that business for the next 6 months? Or do I start to pay myself? So there are 2 things that I would want entrepreneurs to learn immediately. One is your break-even point. Your break-even point is the point at which you are no longer losing money. You know, where your profit, your costs and your revenues are equal to each other. Once you hit your break-even point, it means that at least your blood cells are not dying and you are not regenerating new blood cells. So you are at least going to survive. You're able to meet all your expenses. You're able to you will just be fine. However, when you start to make a profit, then you can start to think of paying yourself. So usually I would say in the first 6 months of a business, don't expect that the business will start paying you. You know, even for people in entertainment or in businesses that don't require a huge outlay, the reality is that make sure that you've been able to keep that business running for 6 months before you start thinking of paying yourself. I think there are two contexts to take. So let's take the first context. The first context is in the context of you and your customers. And there's also in the context of the type of financing that you get for your business. So I want to separate both of them. And we'll talk about both. Good debt is basically you have a regular customer that when you supply them goods, you say your payment is due within 2 weeks. And on day number 13, that person pays. That is a good debt. That is a good customer to have. But bad debts are basically you sold Ankara to someone. They were supposed to pay in January. By June, this is 6 months later, you're still sending the person text messages and all of that. That is bad debt. The tendency is that the longer that a debt stays unpaid, the more likely that that debt is not going to be paid. Because as human beings, the way people generally deal with debt is to basically say, you know what, I didn't pay him last month, he didn't die. So let me push it, let me kick that can down the road. But if you have the discipline, for example, to always chase up on people that are owing you, and you be unrelenting in chasing up on them, the tendency is that you would reduce the quality of bad debt that you have. Are there businesses that don't have bad debts? No, there's no business that doesn't go through that process. Even the banks, who have all the collateral in the world, if you look at their books, every year they're always writing off debts that have not been paid by people. So that is on the trading side, what good or bad debt is. Now, on the financing side, there's a completely different context. Debt is always good for a business. But the importance when you're going to collect debt or when you're going to obtain debt from anyone is there are two things that are very important. What is the cost of that debt? And what is the repayment terms? What are the repayment terms of the debt? Now, of course, good debt in that context is that if someone has given you very generous costs and very generous repayment terms, that's excellent debt. Because what happens is that means that your business is able to easily fund the cost of repayment. But there is bad debt. Now, if you've gone and borrowed from a bank and they're charging you 5% or 7% every month or 8% a month, and they're asking you to pay back that loan within a year, and your business has just started. Your business is still trying to it's still trying to break even. You are going to find yourself under significant pressure. And what you will find is that you will start to use other resources, you will need to use other resources to meet the repayment obligations on that debt. In fact, in more interesting circumstances, you would have to go and borrow worse debt to pay off that debt, just to make sure that you don't default. When you run your budget, two things we always say about budgeting, and just to tie it together. A lot of people are very optimistic when they're budgeting. To say that, oh, I'm going to sell 2,000 widgets, but you don't know where those guys are coming from. You don't know you don't even know who wants widgets in their homes. The point is, when you are budgeting, you have to be very disciplined and you have to be very realistic. Realistic about how many products you can sell or how many customers that you can attract. And you also have to be very realistic about your costs. So in budgeting, we say there's base case, there's worst case, and there's best case. You must always budget with your worst case in mind, which means my costs are higher than I thought they were going to be. My revenues are lower than I thought they were going to be. And when you're creating a financing structure, you must use your worst case as your base case financing structure. When you have that discipline, you're basically now like someone who was expecting to eat rice for dinner, but gets to the restaurant and they've offered him stew and Coca-Cola or Fanta for free. That is a best case scenario because you've prepared yourself that all I'm going to be eating is white rice without sauce. But someone has provided you something extra. And that's the way you have to consider budgeting. Budget from the fact that I can only get the least revenues and the highest cost. If you have that, when you are financing that business, you will be financing from a very realistic perspective. And that is extremely important for an entrepreneur because if you remember what we said at the beginning, businesses die because they run out of cash. And if you budget from the worst case cash position you can be in, what you've done is that you've insulated yourself from negative occurrences, and which would obviously dovetail into the way you structure your financing.
Hi, I'm John Obidi, and I have a ton of hobbies. You know what I love the most? Making money with little or no stress. Using the iInvest app, I can invest my money in treasury bills and watch it grow in value. You can get started with as little as 100,000 Naira or as much as 100 million Naira. Download the iInvest app from the App Store and the Google Play Store, create your account, and make your first deposit.
So your fixed costs are basically costs that you incur no matter what. There's a saying that two things in life are constant: taxes and death. And you can almost take it that way. So your fixed costs are those costs that, irrespective of whether you sell or not, those costs must be incurred. So salaries, for example, of your staff is a fixed cost. Whether you sell 1 unit or you sell 300 units, you need to pay for those costs. The cost of paying your rent, if you are renting a place, you must pay that rent, whether you've sold or not. Fixed costs could come in form of wages to ad hoc staff. Basically, any cost that cannot be waived just because you're not doing business is a fixed cost. And what we always say is that you must always recover your fixed costs, no matter what it is that happens. Second is variable costs. Variable costs are costs that vary depending on the level of business that you do. So for example, if you are someone who was selling hair, if you buy 5 pieces of hair, you would only have the cost of 5 pieces of hair. If you increase that to 10 pieces, your cost obviously increases to 10. To the cost of 10 pieces of hair. So your variable costs are costs that react to the level of business that you're doing. Now, in terms of your break-even, we're saying that your break-even point is the point where you can recover both your fixed costs and your variable costs.